Hello, today is the 1st of October 2009. Hope everyone is doing magnificent. In this video I'm going to be covering a lot of different economic issues that is going on right now. Bernanke spoke today. I didn't watch too much of it, but he did say that this bailout has been just driving him more sick than anybody else. I think what he's sick about is the fact that banks aren't lending the money. And even if they were, of course, this is the problem that got us into the mess anyway, is how we have banks lending money to other people. They're charging interest rates. And every single time interest gets charged, that creates debt. And because the monopolization right now of the Federal Reserve, it's just a problem waiting to happen. That's pretty much happening right now. That's all I'm going to cover on that. And there isn't any links towards that, but there is some links in the more info. The first one, Donald Trump spoke on Fox Business. There's a YouTube video in the more info. And first off, he was saying that things are certainly better, but he was not saying they are for the future. As he mentioned how banks are not lending money to pretty much anybody right now, that without having money being lent, there's just no way for the unemployment to get lower if you don't have any job creation through business ventures. In fact, there's less money being lent today than there was 2 or 3 months ago, and back then it was very hard for people to be lending money. He also mentioned that the bailouts last year was a good thing because it stopped the depression from happening, how we would have had a big time depression. And he also mentioned that in case of a bank run, that even the #1 top bank cannot handle a bank run, that is. And after I listened to that, I think to myself, well, what's the chances of a potential bank run? Because that's part of my intellectual, analytical thinking, that I think of the probability odds, and you don't have exact data to give you an exact percentage. You only have to try to guess what that percentage is. And I'm not going to try. I could say maybe it's 75%, maybe it's 95%, maybe it's 2/3 or 67%. And to me, anything over 55% is probable that we're going to have a bank run. And if you know the chances of that are going to be, then you want to be able to get your share of the bank run, or do your part of the bank run well before everyone else does. This way, if a bank holiday happens, you are ready for it. Bank holidays can only happen when A, you have a lot of people going to the banks, taking out their money, people selling their stocks, and not only selling their stocks, but taking the cash. Because if someone sells a stock and keeps their money on the sidelines or in cash in their equity market, banks don't care because the money is still there. But when you sell stocks and then try to turn it into cash, that is problematic for when a lot of people do this at one time. And there's a lot of potential that this could happen maybe later this year or even into the year 2010, especially with all the news that is going on right now with the United States and their dollar looking like it could be losing its value as the #1 reserve currency in the world. There's been a lot of countries from different areas, Russia, China, and so many others who want something new. In fact, we have had other countries deciding to stop trading in dollars, maybe in euros, and that could easily cause bank runs. Of course, the second reason for a bank holiday, which might be a more devastating one, is an event set up by the powers that be. I had one comment on YouTube saying that it's either going to be one of those slow kind of deaths that it seems like is going on right now, or a pulling the plug by the powers that be. It would sort of like be them pulling the plug, which would have to be some sort of devastating event. Moving on right now, Donald Trump also said that the depression was delayed from, or they didn't say that the depression was delayed. I said the depression was delayed. He said that the depression was stopped because of the bailout money. To me, I see it being as in that of being delayed, and also giving some people who were still into dollars, still in stocks, a chance to get out, because there's been a lot of time now for people to prepare for this. The information has been easily accessible here on YouTube for now about 2 years, but definitely for the last 18 months, this information has been there. So there's been a lot of time to prepare for this, and I wish I could tell you how much more there was, but I'm not able to because of the inability to have an effective crystal ball, which of course is obvious. The next article sent to me by email, a very great article, Financial Sense Observations article. These have some great charts in it showing some consumer confidence charts, and a lot of these charts, when you look at them technically, do support more downside towards the economy. You look back at previous depressions and previous downturns and how we were able to get out of it. This time, where we are at now, people are saying, well, consumer confidence is higher, and it is, but we're also at the point at previous support for a lot of these charts, which is a very bearish sign, because this could result in a lot of downside this year, going into this month, November, and into December. There's also a thing in there where they talk about the stock market nowhere being close to the leading indicator for the economy, something like 3%. They mention that the biggest indicators for the economy is that of the money supply and the employment. The Labor Department said today that initial claims for unemployment benefits rose to 551,000 from 534,000 the previous week. Wall Street economists expect an increase to 535, so well below economist expectations from a Thomson Reuters survey. Tomorrow we have unemployment numbers coming out. Last month it was 9.7%. They're expecting 9.9. Maybe we might get to their 10% number, which is very psychological. And yes, of course, that to me is not the true unemployment rate. I'm sure a lot of people watching agree that you could say it's 17, 20, 22%. But a lot of the people who watch the television, they see this as what they believe to be the real number, because they still believe government data. And psychologically speaking, those who do believe the government data will see this 10% double-digit number, which could cause a panic, which may lead to addition to the bank runs. And then you got those who are aware of the situation, and of course they already know what is going down. But more and more people are turning on to this sort of media, like I've been saying, that's been going on for 18 to 24 months now. And in fact, there is a new video made by the BackBurnerNews channel, and it was Fred Wakes Up the Sheep, a little parody, if you will. Of course, this video isn't getting 5 million views like Fred gets, but it would be nice to see it get a lot more. If you haven't watched that video, please watch the link of the more info. And if you haven't subscribed to his channel, if you haven't subscribed to his channel, definitely worth the subscription. He puts a lot of hard work and a lot of hard effort towards his channel. Moving on, gold now has been flirting with this $1,000 mark for the last 20 trading days, or 4 weeks or a month. And this has been very significant, because previous times where gold flirted with 1,000, it couldn't see that level for much more than a couple of days. Now we've had 4 weeks of testing this 1,000. This doesn't mean we're not going to pull back, because if the stock market falls lower, it's going to be interesting to see what happens with gold. We see the Dow Jones go to 8,000, maybe below it. Maybe we may see gold go to 900 or 870 as a possibility. But you also don't know that for certain, as how much money is going to be put into gold and silver, as of course people exit out of stocks. They sell stocks. Where does that money go? Some of that money goes into bonds, Some of that money just goes right into cash. Some of it goes into gold and silver and so on. So that'll be interesting to see. If, of course, we do have a dip down in gold and silver, what this means is it is a buying opportunity. And I don't mean buying GLD, SLV, or going on the futures derivative markets. What I mean is actually buying the real physical metal while it hasn't gone up a significant amount of dollars, that is. I'm not saying that it's going to go to 800 because it wouldn't surprise me in the next 6 weeks if gold goes to 880, and it wouldn't surprise me if gold goes to 1200. Either way, because like I say, it goes towards who's going to put the money in from the leaving of the stock market. Moving on with the stock market, the VIX Volatility Index is breaking out to the upside, breaking some key levels of resistance. Some technical indicators are starting to point for it to be going higher. We have now had 4 consecutive days of the rising 50-day moving average, and today that moving average is going up a lot higher because the VIX is up around 10% in mid-afternoon trading right now. And we are now at that 100-day declining moving average. This is the second time it has tested it. The first time was on the 1st, 2nd, and 3rd of September. So what this means is this. For the markets to sell off, the first thing we needed to see is we needed to see the 50-day moving average flatten out. Now, that took a long time, so now we need more. The 50-day moving average has flattened out and has risen. So the next step now is we need to see the 100-day moving average flatten out. That's still got a little bit of work to do. And we need to get above 30. And we're about 27 and change, closing in on 28, which means we're about 8-9% away from hitting that level. When that happens, when you have a rising 50-day moving average, a rising 100-day moving average, and a VIX total over 30, that's when we might start to see these weeks where the markets lose over 10%, maybe these 300 or 400 point down days on the Dow. As far as the S&P 500 is concerned, we now have a declining 5 and a declining 10-day moving average, which means on the intermediate term, that leads to a bearish indicator. We need to see the 20-day moving average flatten and go lower, which looks like might potentially happen before the end of the week. As at 10 o'clock, we had a major move down where the markets lost about 0.75% in about 60 seconds. That move got us below the 20-day moving average, which has been acted as a key level of support. And going below that means that we potentially could be going lower. Now the next key level is the 50-day moving average. And we are very, very close to this now. We were last below the 50-day moving average in June and July. The key thing on this 50-day is you don't not only have to go below the average, you need to have that average start to decline. And what I mean with advancing and declining, what that means is if I say there's an advancing 50-day moving average, this means that the index is higher today than it was 50 days ago. I say we have a declining 10-day moving average. What that means is that the index today is lower than it was 10 days ago. So that's pretty much what it means. When you have a flatlining moving average, that means it is relatively the same from that period ago. So a declining 50-day moving average will mean that the stock prices are lower than they were 50 days ago. But there's a lot of psychology involved in this because a lot of big-time professional traders and bank institutions use that as an indicator for bull and bear markets. And this big run-up we've had since March, a lot of the money that has been bought, we're not talking day traders, we're talking long-term traders, a lot of that money will be on the sell side when indicators like this happen, which could justify a test for the Dow Jones going from 8,000 or to 8,000 and maybe even going below that to the 7,500 level relatively soon within the next 5-6 weeks. Because when markets sell off, generally speaking, they go down faster than they go up. It's a total difference with the euphoria or the trying to get in before the markets got too late. And then the panic for getting out is a lot more relevant, volume higher, and therefore that's why a lot of times the gains you might have in 1 month could sell off in 1 week. That's been very normal throughout the entire history of the stock market. 2 questions of the day, both of them regarding silver. Scott writes in an email, I'm looking to accumulate some precious metals, mainly silver, since it is in my price range. Does it matter who mints the coin? To me, it doesn't matter as long as it's silver. Beware of hearing stuff that says silver plated, because that's not really silver. You want to look for fine silver, even the scrap silver from the silver quarters and dimes and silver dollars. That, to me, as long as it's silver, that's what is important. So whether it's a Canadian maple, an American eagle, Liberty Eagle, or if it's just one of those no-name brands, if you will, if it's fine silver, it's silver, because the reason why I do like silver is because of its industrial uses, meaning that the plan would be to sell it later on down the road for those who are going to melt the silver for uses of industrial uses. So maybe solar panels, which is the next big thing, along with its everyday uses now, stuff like clothing. The medical field uses it quite often, photography, that type of deal there. So that's why, to me, it doesn't matter who makes it. Second question, this is from Rick. I am deciding how to store silver. The bank says that unless it is left in their safekeeping, it may be subject to assay charges and a delay in payment when I resell it back to them. And he's also mentioned that to keep it there, it's costing $1,500 a year, which is just outrageously high. And myself, I believe in storing your own metals yourself. If you are rich enough where you have a lot, you have multiple ounces of gold, you have palladium, you have multiple ounces of silver, maybe multiple pounds of silver, then I recommend buying your own protection area safes. If you have pounds of silver and many ounces of gold, then you should be at the financial situation where you can afford safes that should generally be good at even like $400 or $500 will get you a really good one. And even if you're just a casual one, you can get a safe for under $100. So personally, I use a safe myself. I never was asked when I bought it from the bank, or they never said anything to me about this, and I wouldn't even plan on selling it back to them. My plan, like I said in the previous question, is to sell it to those for the mining situation or the melting situation for all of the industrial uses. So whether that be 3 years, 5, 10, or 20 years, the plan would be to sell it to someone who is melting it, and of course they would use it for distribution of stuff like solar panels. That would be my plan there. Of course, right now it is illegal to melt the coins, like the bullion, not the bullion coins, but the quarters, the dimes, the $half-dollars, the minted coins from Canada, US, most likely all the other countries. And I think that's all going to change in the next few years, as the importance of needing silver is going to have to be done through that method. And I mean, the governments melted their own metals many years ago anyway, so that would be my plan for that. Remember to send a question, send it to me at endlessmountain2008@yahoo.ca. The link is in the more info. If you want to have a video question, please make it under 10 megabytes in size. Thank you so much for watching this video, and have yourself a great day. Bye-bye, everyone.